Jake buys a rental property. Marcus puts the same money into the stock market. 10 years later, they sit down and pull up their numbers, and the guy who feels richer isn't the one who actually is. Stick around, because by the end of this video you'll know exactly which one that is. Let's keep this fair. Jake and Marcus are both 32. Both earn $58,000 a year. Same city, same job level, $56,000 saved in the bank. The only difference is what they do with it. Jake takes his $56,000 and puts it down as a 20% down payment on a $280,000 rental duplex in a neighborhood the listing agent calls up and coming. He finances the rest at 6.75% over 30 years, about $1,455 a month. He finds a tenant in 3 weeks at $2,000 a month rent. On a napkin, that's $545 a month in profit before he spent $1 on anything else. Jake does the math at the closing table and thinks he just found the cheat code. He texts his brother a screenshot of the number that same night. Marcus takes his $56,000 and puts it into a total stock market index fund, sets up an automatic $250 monthly contribution, and doesn't touch it again. No tenants, no closing costs, no inspection. At his sister's wedding that fall, someone asks what he's doing with his savings. Index fund, he says. They nod and go back to asking Jake about the duplex. Nobody toasts a Vanguard confirmation email. Day 1, Jake has a physical asset, a tenant, and a story. Marcus has a number in an app. It's not close in terms of how it feels, but this is a 10-year story, not a day 1 story, and feelings and math are about to have a very long argument. For the first 2 years, Jake is living it. Rent lands on the first of the month. He drives past the property sometimes just to look at it. He deducts mortgage interest and depreciation and knocks about $2,100 off his tax bill in year 1. Comparable units 2 streets over are selling for more than he paid. Everything feels tangible, active, smart. Marcus checks his account maybe once a month. Year 1, his $56,000 grows to about $61,000. Year 2, roughly $67,500. No milestones. No dinner party material. Just a slow, quiet climb. Here's where the real numbers start talking back. Jake has collected $72,000 in rent over 3 years. His mortgage payments total $52,380. That leaves $19,620, which sounds fantastic until you subtract the rest of his life. Property taxes, roughly $3,300 a year. Insurance, another $1,400. A garbage disposal and a section of fencing, $900 combined. 1 month of vacancy between tenants cost him $2,000 in lost rent plus $500 to clean and relist. He's self-managing to dodge the 8 to 10% a property manager would take, which is why he's the one taking a call about a clogged drain at 9:40 p.m. on a Tuesday, standing in his own kitchen with his kid asking why he's leaving. After every real cost, Jake's actual net cash flow over 3 years lands around $6,000 to $8,000. Not the $19,620 the napkin promised. And that number still doesn't pay him $1 for his own time. Marcus, meanwhile, has put in $56,000 up front plus $9,000 in contributions. At a 9% average annual return, his portfolio sits at roughly $84,500. He hasn't taken a single call about a drain. But Jake has one thing Marcus doesn't: leverage. His $280,000 property has appreciated about 4% a year and is now worth close to $315,000. His equity, what it's worth minus what he owes, has climbed to about $99,000. A chunk of that is money he never actually put in himself. That's the one lever stock investors can't easily pull. The rent check is the number everyone hears about. What nobody hears about is everything that quietly leaves that check first, and it isn't abstract, it's specific things that happen to Jake by name, in order. His first tenant leaves after 2 years, and the unit sits empty for 3.5 weeks before the next one, a full mortgage payment gone with nothing behind it. The following spring, the water heater dies on a Saturday, $1,600, cash he wasn't planning to spend. A year after that, a pipe under the kitchen sink lets go while the unit's occupied, $1,100 for an emergency plumber who charges double for a weekend call. None of it is catastrophic. All of it is real, and none of it shows up in the $545 a month number Jake quoted his brother. This is the general shape of owning a rental, whoever you are. 1 to 2% of the property's value a year in maintenance, roofs and HVAC systems that fail in $4,000 to $12,000 chunks when they fail, and, the one nobody wants to think about, a tenant who stops paying and knows the eviction timeline, which can erase a full year of profit in one swing. Jake gets lucky and never hits that last one. Not everyone does. By year 5, Jake is on his second tenant. Rent has climbed to $2,150, which helps. Property taxes and insurance have both crept up too. His real cash-on-cash return, the actual cash he keeps relative to what he put in, is sitting around 4% to 6% after every real expense is counted. Solid. Not the 15% he mentioned at that barbecue 2 years ago, and he stopped mentioning a number at all. Marcus is still doing nothing, which by now is starting to look like a strategy. His portfolio has grown to somewhere between $103,000 and $112,000. He hasn't picked a single stock, hasn't timed anything. The gains on his gains are starting to outpace his own contributions, the exact moment compounding stops being boring and starts being the whole story. Here's what neither of them notices in real time. Jake's wealth is growing, but it needs him to keep growing. Marcus's wealth is growing on a curve that doesn't ask him for anything. By year 7, Jake's property is worth roughly $368,000. His mortgage balance has dropped to about $195,000, equity around $173,000. Over 7 years, his total out-of-pocket spend beyond the original down payment is somewhere between $9,000 and $15,000. Not bad, especially with leverage doing the heavy lifting. Marcus's portfolio, same $250 a month, same 9% average return, is sitting at approximately $148,000 to $160,000. He's put in $77,000 total across 10 years of contributions. The rest, more than $70,000, is compound growth he didn't lift a finger for. Now year 10. The number this video is actually about. Jake's property has appreciated to roughly $415,000. Mortgage balance down to about $178,000. Equity, approximately $237,000. Add his net cash flow after all real expenses across the full decade, $18,000 to $24,000, and Jake's total position lands at roughly $255,000 to $261,000. That number came with hundreds of hours of his own labor folded into it. Phone calls, showings, repairs, tenant screening, contractor coordination. None of it shows up in the dollar figure. All of it happened. Marcus's portfolio after 10 years sits at approximately $214,000 to $228,000. He put in $86,000 total. Everything else, over $130,000, is compounding he never had to manage. So on paper, Jake is ahead by $30,000 to $40,000. Real estate wins the raw number. Here's the part every real estate always wins video conveniently skips, and it's the actual answer to the question this video opened with. Jake's $255,000 is mostly equity, meaning it's trapped inside a house. He can't spend it without selling or taking out a home equity loan. Selling means 6% in agent commissions, roughly $25,000 gone instantly, plus closing costs. His real liquid number after a sale is closer to $215,000. Almost dead even with Marcus. And that's before counting a single hour of his time, at even minimum wage, across a decade of nights and weekends. Marcus can sell $500 of his portfolio on a random Tuesday from his phone in under a minute. No agent, no inspection, number 45-day closing window. That's the twist. The winner and the loser are separated by less than the cost of a used car once you account for what each dollar actually costs to access. The bigger number isn't the better number. It's just the more visible one. If I only made the case against index funds, I'd be doing exactly what every real estate account does to stocks. So, the real downsides, no hedging. Volatility is brutal and it's not theoretical. In 2022, the market dropped roughly 19% in a year. If Marcus had $180,000 and watched it dip to $145,000 in a matter of months, that's not an abstract number, that's a genuinely uncomfortable stretch. Real estate values move slowly and don't show up as a red number on your phone every morning. That psychological stability has real value, spreadsheet or not. There's no monthly cash flow. Marcus's account doesn't send him a check he can spend on rent or groceries. Jake's does, every month, market up or down. There's no leverage. Marcus used $56,000 to control $56,000 of assets. Jake used $56,000 to control $280,000. That 5-to-1 multiplier is the single biggest reason Jake's number came out ahead at all. And there's no depreciation shelter. Jake deducts a theoretical decline in his building's value every year, even while the property is actually rising in value. That's a legal advantage stock investors don't get outside a retirement account. Real estate wins in specific, identifiable conditions. If monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works for you from day one instead of fighting you. If you run it like a business, screening tenants properly, budgeting for capital expenses before they happen, the returns can beat stocks outright, especially with leverage compounding underneath. And if your 10-year window lands during a strong appreciation cycle in your specific market, real estate can pull ahead by a wide margin. Exactly like it just did for Jake. Don't ask which asset class wins in general. The honest answer is neither does, in general. It depends on your local rent-to-price ratio, your appetite for a 9:40 p.m. phone call, and how much you value being able to touch your money without a 45-day closing process. If you've got the time and stomach for that call, and a market with genuinely strong rent ratios, real estate can outrun stocks over a single decade, like it did here. If you want your money working without requiring anything from you, and you'd rather sell $500 in 30 seconds than sell a house in 45 days, the index fund gets you 90% of the wealth with none of the second job attached. Jake and Marcus both walked away from year 10 sure they'd made the smarter call. Jake had the bigger number. Marcus had the free Tuesdays and the money he could actually touch. Neither one was wrong, and neither one had the complete picture, because the complete picture never fit in a 10-year dollar figure to begin with. So next time someone tells you real estate always beats stocks over 10 years, or the other way around, ask them one question: did they count the hours, the liquidity, and the zeros? Because the answer that counts everything is the only one that matters. And if you're wondering what this looks like when you do both at once, buy the property and keep investing, that's a different video, and the math might change everything you think you know right now.